Alright, this video is going to be on the wave chart. And I'm just going to go into it. The wave chart is very important. Not only does it teach tape reading, but it helps to identify turning points and allows you to study the market as a swing trader later on during the day. And by swing trader, I don't mean like, just a person who trades for a longer period of time. I mean to get the what Wyckoff called the 3 to 5 points, meaning like in day trading you're in and out the same day, but the problem with day trading is you cut your winners short. You'll get in, but you'll cut them short end of the day. That's a major drawback unless you're trading a highly volatile stocks with big intraday trends. The problem with day trading is that you cut your winners short. So a lot of these waves, as you can see, they don't last one day. They last like even the small swings last like 3, 4, 5 days, all the time. So for this, do you really want to watch the tape, or do you just want to watch a wave chart? A wave chart will give you all the elements that are required, meaning the ability to judge support and pressure, ability to see how much progress moves, tests and responses. Basically an understanding of all the key factors you need to determine not only trend, but a change in trend, or a change from strength to weakness or weakness to strength. These are all recorded and can be determined from the wave chart. Now, when Wyckoff created the wave chart, one of the things people ask is, what do I use? Do I use the high, low, close? When Wyckoff did it, he combined the highs and the lows. So he used the high-low. But I've seen plenty of times you can also use the close based on the closes, not just the highs and lows. Right. And that'll do fine. So it really doesn't matter, but if you want to be strict, go ahead, use the high-low. Alright, so now I'm going to analyze this wave chart over here. Alright, I'll use the top to zoom in on the chart, so y'all can see it. So that's the chart, A, B, C, D, E, F, G, H, and all that, okay? So, let's start. Okay, so the first up wave from A to B was 3 points. That right there is 3 points. Alright, so what factor is that? Obviously, it's the change in price. So the price factor. The time is 20 minutes. 20 minutes, and he used a 5-minute chart, by the way. Alright. So just understand that it went from A to B on a 5-minute wave chart. He doesn't give the rotation for some reason, but I don't know why he doesn't do it, but it went from A to B, 3 points. That's what you got to know. That's the factor. It's a change in price factor. How long did it last? 20 minutes. That's time. So it went 3 points, 20 minutes. Alright? 3 points, 20 minutes. So I'm going to start marking it up so it's very clear. Where's that fucking thing? Alright, so here, 3, oh shit, it's too small. 3 points, 20 minutes. Alright. Use red. Alright, so 3 points, 20 minutes. The down wave is 2 points, 15 minutes. Alright? So which one is stronger? Obviously, the up wave is stronger. Demand is therefore greater than supply. Now, suppose the next swing is 45 minutes. 5 minutes. But how much does it move? 4 points, 45 minutes. So we go 4 points, 45 minutes. Alright? Now, this indicates an increase in buying power because it was 4 points. You see, it goes from 3 points to 4 points. The wave is bigger. Up wave is bigger. And the buying wave CD was sustained for 45 minutes compared with 20 minutes. As the next reaction, 20 minutes is only 5 minutes more. Alright, so where's DE? DE, 20 minutes and 1.5 points. So, we put that shit there. 1.5 minutes and 20 minutes. Alright. 1.5 points and 20 minutes. Oh shit. Alright, so what factor increased on the down waves? What increased is the time. It went from 15 minutes to 20 minutes. But is that something to be worried about? Not really. Did price increase? No. This down wave is 2 points. The other down wave is 1.5 points. So it decreased. Why did it decrease? Not enough selling pressure, that's why. So, we notice that in the down waves, the price decreased, the time increased. The price decreased by 0.5, the time increased by 5 minutes. So because the price is less still, it's a confirmation of strength. Following these indications, you find that E to F lasts 40 minutes. Before I go any further, notice the price is still less. So that's why he's saying it's still confirmation. Alright, it's confirmation because the price is less. Even though the time increased a little bit, the price is still less. The first thing you want to see is a change in price. Then we can talk about a change in time. Anyway, so E to F lasts 40 minutes and lifts price 4.5 points. So 40 minutes, lifts price 4.5 points and 40 minutes. Again, do you see like any indication at this point? No. Time is slightly less, 40 minutes. Price is more. Alright. Now the F to G dip lasts 30 minutes, a little longer than the previous one, and amounts to 2 points. So this is important. Alright, F to G dip is 2 points and lasts where is it? F and G. Lasts 30 minutes and 4.5 points. Oh, wait. F and G dip lasts 30 minutes and 2 points. Alright. Alright, now you have some issue. Why? Because the price down increased from 1.5 to 2. and time increased. Price and time increased. Okay? It's a little bit longer and amounts to 2 points. This reaction shows an increase in time and price. Alright? So the increase in price and time. Right there's your increase in price and time. This warns you to look out for a change. Alright, the time increased by 10 minutes, price increased by half a point. This is your warning. That's your warning sign. Merely to emphasize how the chart should be interpreted, let us suppose you're a day-to-day trader, okay? When the rally GH only 1.5 point begins to die out in 10 minutes. So now watch this. This move right here, GH, which is the rally attempt, is how long? Is 1.5 point and 10 minutes. Alright? How should I put this? Alright. So this rally GH is 1.5 point and 10 minutes. You decide to act because this 10-minute bulge lasts only about 1/4 as long as the previous rise of 40 minutes. So what do we see? You see over here, time is 1/4 of prior upwave. Okay? Why? The prior upwave is 40 minutes. This move up is only 10 minutes. So it's 1/4 the time. So that right there is like that bear flag, you know, go down and up. So go down and up, and it has nothing on it. This shows that the buying power has practically exhausted itself on the prior upswing. So what is this telling you? This is a confirmation that this one here is completed. Get it? The time dips from 40 minutes to 10 minutes, which confirms that the buying power of the prior wave is exhausted. What does that mean? The market is failing to attract followers. It does have a clear indication that supply is overcoming demand and the trend is turning downward. Less time means less of a following. Alright, it's a little bit hard to do this, but it's alright. Okay, so the rally from G to H was only 1.5 points in 10 minutes, and it's less time and less price, you know, significantly less. And that told you that the prior upwave was exhausted, that current demand is weak, it can't attract the following. Therefore, as HG begins on the tape, that is your cue to sell out your longs. Alright? So HG, this X right here is right after the retracement, like right after the turn. H is after the turn. It is not on the break. It is after you have a reversal. Now, the move down, HJ, it goes down for 50 minutes, 3.5 points. HJ is 50 minute, 3.5 points. Okay? What does that mean? It's confirming weakness. How the hell do I draw this? Anyway, doing the best I can. So go down 50 minutes and 50 minutes and 3.5 points. Obviously, that's big, right? Then definitely bigger than the prior down wave. The short rally JK is only 10 minutes. All right, 1.10 minutes. JK is 1.10 minutes. Now, what does that mean? It means it's less price and less time. Something like that. So it's the smallest so far. Less price, same amount of time, but less price. So here you go again. The short rally lasts only 10 minutes and emphasizes the weakness because it amounts to only 1 point compared with 1.5 points in the prior rally. So this current rally is short, showing there is no buying power left. If you did not go short the market, you should do so now, immediately after the market hesitates at K, and begins to sag. If you did go short, sell a second lot. By the way, this instruction is for day trading, how to trade using the wave chart. Reduce your stops on the first lot to a price fractionally above the high made at 1220. Alright, so the initial short was after H died out. So where does the stop go? The stop goes above the rally high about 2. So that's the initial stop. So stop is about 2 points above the high after you take the short, and then when this happens, you move the stop. Okay. So as the market hesitates at K and begins to sag, if you didn't go short before, you might now sell a second lot at the point XX. So these are the XX points, right? X is your first, XX is your second lot. So after K begins to hesitate, short it, and reduce your stops in the first lot to price fractionally above the high, and your fractionally above the high of 1220. 1220. All right. The decline KL runs for 20 minutes. KL runs for 20 minutes and goes down for 4 points. Alright, so go 20 minutes, 4 points. And at M you have a rally. It only rallies what? Fucking rallies. So it's a 15-minute rally right there at M. And then finally at N, 20 minutes, 6 points. Okay. Here you may cover or whatever. You can cover if there is indication. If there is no indication, don't cover. Okay. Now here's an important point. After he does this, he used price and time. So as you can see, let me just write a note. Bullish. Anyway, I don't have any space here, so anyway, what was I saying? Alright, so this illustrates how the daily wave chart should be read from the perspective of price, time, lifting power, or pressure. Basically, pressure is down, selling pressure, and lifting power is demand. So it's just supply and demand. And how it may be used as a valuable aid in timing your commitments advantageously when you are looking for logical buying selling points on which to open or close your position for the 10 or more point swings. Okay. The same reasoning should be employed in your studies of the larger waves, that is, those which make up the market's other trends. And the cumulative impression you get from day-to-day analysis of the wave chart will help you observe how and where the small waves are merging into the turning points of the big waves. Alright, so here's the key point. You have a higher time frame and a lower time frame. You need wave charts on both. That's it. Alright, so you have a daily chart and maybe you have a 5-minute chart or something like that. You need a wave chart of the daily and the wave chart of the other one, the minor. Alright, that you need that to identify trend changes. That's what he's saying here. Thus far, we have not considered volume or activity because it's better to understand how to judge the factors just enumerated: price, time, basically price and time. After you master price and time, study volumes and the intensity of action. Intensity of action is activity. Volume and activity are not the same. Activity is a different factor than volume. For example, if you have a rally with 100 volume, for example, and another rally with 100 volume, the volume is the same, but the activity could be different. Alright, activity could be totally different. Activity is basically the rate of orders coming in to the market. The rate of that order, like order flow in terms of the rate, how fast it's coming, how many transactions. Alright, that's what activity is. The volume could be the same, but the rate of activity could be different. So one wave may have taken 30 minutes with 100 volume, and the other wave only took 10 minutes with 100 volume. The volume are the same, but the activity is different. Why? One wave 10 minutes, it had 100 volume, and the other one took 30 minutes. So obviously one has more activity than the other. That's activity. Anyway, but you cannot use it as a ratio like that. Like, okay, time divided by some price or volume or whatever. The ratios will not work. For some reason, it just doesn't work that way. Activity is the rate of the order flow, but it's not a ratio. The key distinction. Anyway, since the average trader and investor does not have time or equipment, they give it to you. But nowadays you have the time and you have the equipment, right? So all of this shit is available, I think. So over here, the wave chart of tape readings and the pulse of the market. Duration here is the time, the change in price, the volume, and the activity. As you can see, activity is a separate factor. It's not the same as volume. That's why it's in a separate column. Okay. Alright. So you have time, basically that's the time the wave lasted, the change in price, the volume, and the activity. Activity, again, I don't know. They have their activity index, and I don't know how to calculate it. Some SMI can tell you how to calculate it, but I doubt it, because they actually looked at the length of the tape in feet to determine it. There should be a more modern way of detecting this. Like, you could take the amount of orders in a I don't know, the amount of orders in the wave, like from low to high of the wave. The amount of orders would help you, and then some type of measurement of activity would need to be used. Or you could just use price, volume, and be done with it. You can just use that, you know. Is it necessarily to use all of these things? I wouldn't recommend it, because it's very unlikely that you're going to be able to read it quickly. It becomes too taxing. But sometimes I do use price and volume instead of just volume, because I want to see the ability of the market to push price. Alright. There's a zigzag indicator is what you want to use. is he doing? So you could also use hourly periods. Again, that change of pace. I don't know how to do change of pace, but so we have to think about how to draw this. Change of pace. The quality of demand on the more critical buying waves and the quality of supply on the more significant selling waves is an important factor. Notice the word quality, because you want to figure out who's buying, public or institutions. Here's an example. It appears that a transaction of an up wave are mostly in 100 lots. The indication is that the rise is not likely to continue because such small lot trading would represent small fry operations, hence demand of poor quality. It's very important. But if on an upwave, transactions are predominantly on 1,000, 2,000, or 5,000 share lots, the indication would be that the demand is coming from important sources and hence is of good quality. By casually comparing activity with the volume and duration of the buying and selling waves, we are able to judge whether supply or demand is of good or poor quality. For example, suppose we have two buying waves each of 10 minutes. So 10-minute waves with 100,000 shares. 10-minute waves with 100,000 shares. But the activity is 5 on one of them and 3 on the other. What does that mean? It means demand is poor on the first wave. Why? Because it has a higher activity. While the market is more active on the first wave with the higher activity, since both time and volume are the same, this greater activity must be accounted for by trading in smaller lots as compared with wave number 2, which had less activity but the same amount of volume. It represents the rate at which orders are flowing into the market, not the ratio between time and volume. It's also important. Nobody knows how to chart it, so nobody knows how to chart it the way they SMI charted it. Ah, well. That's the key. As the smaller buying waves merge into the bigger waves, that's what you want to try to do. And here is the key benefit. If you're able to do this, meaning this, combine the small waves with the big waves, see how they merge into the big waves, whatever the market does, it will nearly in every instance tell you what it's going to do. That is really the best part of it. Alright? That's the level you want to get to. And when the market doesn't, then just don't do nothing. So before taking up the interpretation of these records, we must consider the significance of volume, activity, and support and pressure. Your continuous line chart of the tape reading paced side by side enables you to maintain a complete running history of the market behavior, from which you can observe how the relationship between volume, price, trend, and activity are changing. From this, you can judge whether the market is growing stronger or weaker. These relationships frequently become very important when the market, as represented by the action of the five leaders, is approaching former points of support and resistance. Here's the thing. When activity is increasing while the price is rising, or decreasing while the price is pulling back, except in the case of a climax, bullish. Alright? When the activity of volume is increasing on the way down, except when it's climax, it's bearish. So activity and volume should be increasing on the up wave. Alright? Okay, I'll be back. I think I'm going to do this as part 2 of this section. So we're done with part 1 of the wave study, and part 2 I'll go over the study.